We're calling this the Innov865 Investor Series. What the heck is Innov865? It's really a partnership of a number of organizations, and I wanted to recognize them now. UT Research Foundation, Oak Ridge National Lab, Launch Tennessee, Knoxville Entrepreneur Center, PYA, Three Roots Capital, University of Tennessee Knoxville Anderson Center for Innovation and Entrepreneurship, and TVA are the core founding members of that group that basically enabled all of this to happen today. So for all of you that are from those organizations, thank you for making this possible. And what an awesome turnout. Hopefully this will be, in fact, the first of a series of events in the Investor Series here in Knoxville. To set the stage, just a quick show of hands, how many of you are here as entrepreneurs that have raised money in the past? Okay, great. How many are planning to raise or are raising this year, 2018? A lot. Awesome. And how many of you are here in an investor capacity and you've made investments in Knoxville in the past? And how many are hopefully making more investments in 2018? You're looking to do more. All right, pretty much the same cohort. Awesome. To set the stage a little bit, the governor's economic report that came out a few months ago basically said we're on a great trajectory. So barring something bad in the economy, largely the macroeconomy, Tennessee will keep growing at a rate of about 2.12% over the next 3 years, and that will constitute the longest stretch of growth since World War II. So pretty exciting. For Knoxville in particular, though, I think it's fair to say that end of 2017, beginning of 2018, if someone's writing a book about business in Knoxville, that year is going to be in the book. Because look at the level of mergers and acquisitions activity that's happening in town. Probably the biggest in history, maybe the biggest that we'll ever see. So you're seeing Warren Buffett's company, Berkshire Hathaway, take a majority stake in Pilot. Cineworld is acquiring Regal Cinemas, and Discovery is acquiring, merging with Scripps Network Interactive and bringing their headquarters here, moving a lot of people to Knoxville. So 3 mega deals, and I think that should be exciting for all of us in the room, whether we're investors or entrepreneurs, because when we see those types of mega deals in other communities, lots of good things can happen. It creates a cascading effect where there's a lot more liquidity in the market, so there's a lot of people making investments, and there's a lot of super talented people that come out that can start the next round of startups. So you see that the way it started in Silicon Valley with Fairchild Semiconductor, the way that Austin has been built around Dell Computer. So I'm excited to see the beginning of that, I think, 2017-18 here in Knoxville. So without further ado, let's kick it off and hear from the folks that you all came to hear from, which are the investors. So up here with me, Jack Studer from Chattanooga Renaissance Fund, here from Chattanooga, Grady Vanderhoofven from several organizations, Three Roots Capital and TenneSEED, and Kristina Montague from JumpFund. Thank you all for coming. Let's start with you, Kristina. So tell us a brief introduction, kind of 5 W's, who you are, what you do, what type of investments you make, what size, what stage, what industries, kind of the elevator pitch, if you will.
All right, so I'm with the JumpFund. We are out of Chattanooga, Tennessee, but we are a women-led, women-focused angel stage investment fund. So we are a venture capital fund that plays in the angel space. So pretty early stage, and we are all women GPs and have mostly women investors in both our funds. So we have 2 funds now. We fully invested the first fund in 18 companies and now have a total of 21 between both portfolios, all across the Southeast region. So we look everywhere for these companies. We have quite a number in Tennessee, Atlanta, Nashville, even in South Carolina, so as far away as South Carolina. And we are across industries because we do look for companies that are very much women-led, not just a woman on the cap table somewhere, but so the woman has to be in the C-suite, has to have significant equity in her company, and obviously has to be able to pitch her company to us and have that strong leadership. So we do invest through some accelerator programs. One is Upstart out of Memphis, and we're also now in a partnership with Women Entrepreneurs Initiative in Atlanta, which has 15 companies going through its incubator program right now. So we have one company here in Knoxville, which is MomSource Network, that you guys may know. We would love to see some more deal flow here. So, you know, if you have something that you think is at that growth venture stage that could produce a strong ROI for both of us, then we'd be interested in talking. So.
And then on average or small to large? What
Check
check
sizes?
size are you looking to do in
So
general?
everything from a very small, under $25,000 check size out of the incubator programs. Our average check size is 100 first round, and then up to 400 maybe in later follow-on rounds.
And then compare 2017, kind of what happened for JumpFund in that year, and then how are you looking at 2018? Continue the same trend? Is it going to grow? Is it going to contract a little bit? What are you seeing?
So 2017 is our fundraising year for our second fund. So we've taken in close to $4 million in the second fund, have a goal of raising a $5 to $7 million fund by at least the close of this year. And we have already deployed quite a bit of that capital, so we've been very active already in the second fund, some follow-ons and companies from our first fund, but we're always looking for new opportunity, and our deal flow continues to be very, very strong around the Southeast, and even growing more so as I think women-led companies are kind of coming to the forefront. I was just talking to Jason earlier about they're the new hot thing. Well, we thought they were the new hot thing 5 years ago, so maybe we're just ahead of the curve. But we see tremendous deal flow and a lot of companies that are a little more mature now, which is great when we're actually starting to fund them.
And then any other leading criteria aside from women-led, women founders?
I mean, it's all the basic
things?
criteria we're looking for. We want to see some kind of revenue traction, so we're not that early. We're not, idea on the back of a napkin early. So we want to particularly with consumer goods, but some other products as well, we want to see that revenue traction or at least some strong customer discovery that's happened. We are all about the management team, so we invest in the people at this early stage. So we're looking for people that we can invest in. We see this as a marriage and a divorce all wrapped up into one, and we want to, build a good relationship from the outset. So our small dollars, we feel like they're pretty small dollars going in, really are leveraged by the network of women and other investors that we have that add value to our companies. Everything from HR and IT to marketing, sales, branding, all of that.
Awesome.
Yeah.
Thank you. Jack, Chattanooga Renaissance Fund, give us the lowdown.
So the Chattanooga Renaissance Fund, we're on our second fund. Our first fund was a little bit earlier stage. It was a $3 million fund, roughly, and it was similar to what Kristina describes. It was everything from the $10,000, $15,000, $20,000 really idea stage kind of check, all the way through. I think our average check size in the first fund was about $150,000. So we could go a little bit bigger than that on the follow-on rounds. Our second fund, anybody who's familiar with the Chattanooga market, there's not a whole lot of historical capital down there in this type of investing. So we actually raised our second fund pretty quickly on the tails of the first one. So there's a lot of crossover between the funds, a lot more than most would like to see, but that was sort of out of necessity. And so our second fund is a bigger fund. It's a little over $7 million in that one. And we're writing slightly bigger checks, slightly later stage. We're sort of sliding that way, but trying to keep an eye on the early stage. Excuse me. Average check size there is closer to $200,000. We have capacity. Some of our larger exposures, we're up around the $700,000 range once we're in the follow-on capital and fully deployed there. We take a really measured approach geographically in the beginning. We were exclusively pretty much in the Chattanooga area. That's the Chattanooga Renaissance Fund name. With the second fund, we expanded that a little bit more to be regionally. We're still 85, 90% in Tennessee. We have a couple of companies that are on the West Coast that we got through deal flow partnerships and other stuff. So as far as where we are in the life of the fund, our capacity for brand new investments, meaning the first investment into a company, we just met a company, we're going to put a check in, we're going to reserve capital for follow-on. We're sort of at the tail end of that process. We're focused, this 2017, 2018 break. 2018 and 19 are going to be more about, helping manage our portfolio company, separating the winners from the losers, doubling down on the ones that are really showing promise, reaching a little bit further downstream, helping them with growth capital when they need it, making relationships on the East and West Coast, because of the funding structure in the Southeast and specifically in Chattanooga, we've been aware from day one that we're not, with $10 million under management, we're not taking all these companies all the way to the finish line. So we've spent a lot of time forming partnerships and getting to know funds on both coasts so that, as our companies grow, we can deliver a compelling value proposition to the next round. and stay involved from that. So that's kind of where we're focused on the break between 17 and 18.
And how much capital on average do you keep in reserve versus how much are you relying on the handoff to the next stage investor?
Yeah, we're probably a little heavier on the reserve stuff, just knowing the deal flow that happens in the Southeast. So we typically reserve about 100%. So whatever check size we're writing, we're going to hold back and sort of earmark that same amount. Doesn't mean you're going to get it. And some of our companies we've been through that process of, you didn't make it to the next round. But we try and hold that back. And then when if we make a second investment, we're going to hold back a little bit more. Because we've just seen companies, it's unfortunate, but it's just part of the market. Companies that get through our check size and need that bridge round, or maybe the entrepreneurs were busy running their company and they're a little tight on cash and they think they can raise money in 3 months. But when you start getting on a plane to raise money, that 3 months can easily go to 6 or 9 months, or even when you're just driving to Atlanta or to other cities. So we try and be a prudent investor and help our companies like that and hold back a little bit more than your normal fund probably would to help with that. Yeah.
Awesome. Thanks for coming up to Knoxville.
Sure. Absolutely.
Grady, talk to us about TenneSEED and Three Roots Capital, a little bit of both maybe.
Well, I'll talk about, how about TenneSEED?
All right, let's do that.
The TenneSEED fund is actually a fund in formation, so we're not writing checks today as the TenneSEED fund. The TenneSEED fund is, as the name would imply, a seed stage fund focused on opportunities in Tennessee. And we formed the TenneSEED fund in response to our observation that the Tenvesco program in Tennessee, which I think was wildly successful, and I think there's some debate about that depending on what criteria people use to assess the program. But in terms of the ability of that program to drive capital into seed and early stage companies in the state over the last 5 years, there was a lot of capital. Well, our observation is that capital is not available today the way it was several years ago, yet the need for seed and early stage capital has not gone away. So we envisioned the TenneSEED fund as an answer to the need for seed stage capital. And another thing that's unique about it is we're forming the fund as an evergreen fund. So it's an interesting combination of for-profit and nonprofit entities to capitalize the fund with the expectation that we'll be able to recycle capital so that we can create a permanent source of seed stage equity. Because as these guys know, you raise a fund, you invest a fund, you harvest your investments, you return your capital, and you go do it again. And if any entrepreneur ever thought that a fund manager doesn't understand fundraising, they're mistaken, because you're always raising money as a fund manager. Well, our idea of the TenneSEED fund is it will be an evergreen, permanent source of seed stage capital, and there's a lot to the details of how we've structured it. We spend a lot of time with attorneys and CPAs in doing that. But we want to be a fund that will make proof of concept investments in companies that emanate from, it could be a research institution in the state of Tennessee, it could be ORNL, it could be UT, it could be Vanderbilt, could be somebody in West Tennessee, or perhaps the company comes out of somebody's garage or basement. It doesn't have to be an institutionally generated company. It doesn't even necessarily have to be a technology-based company, although we do have some background in that arena. And the idea is we want to invest in very young companies, not research projects, not science projects, but very young companies where a $25,000 to $250,000 investment has the potential to accomplish a milestone that significantly de-risks an investment, while at the same time substantially increases the value of that investment because of de-risking. So I can't say we have a specific industry focus. I can't say our geographic focus is Tennessee, $25,000, $250,000 check size. Our intention is to launch the TenneSEED fund at about $1 million and to grow it. Because of the evergreen structure, we can fundraise continuously, and we're going to recycle gains in the fund. So we intend to grow the fund over time. We're doing this on the heels of, we had a fund called the Southern Appalachian Fund that we launched in 2003, started investing in 2004. We invested in a couple companies in Chattanooga. And we had a fund called Meritus Ventures, which we raised in 2006 and began investing in 2007. those two funds were about $53 million. We invested about $35 million in 16 companies in Tennessee and throughout the Southeast. Those companies have raised in aggregate about $300 million. We still have 6 companies in our portfolio in those funds. We're still making some follow-on investments. We had several exits last year. We sold a company called Tricycle in Chattanooga, which was sold to a Berkshire Hathaway company, Shaw Industries, which is a subsidiary of Berkshire Hathaway. It was a very successful investment for the investors, but I'll tell you, we were in that deal. We were in that deal for 14 years. We were in that deal for 14 years, and all of the founders of that company were great guys in and of their own right. That company had 3 employees when we invested in it, but none of the founders were still in the company at the end. Right, the evolution of that company over 14 years and how it became successful and reached exit, it was a much different looking entity at the end than it was at the beginning. And I think that's the nature of early stage, seed stage investing. And I think Kristina's comment about trying to surround these companies with mentors and coaches and experience and talent that can help the companies, and Jack's comments about investing with others, having other investors, whether it's for deal flow or just to have other people sitting around the table. We very much buy into that philosophy. We're very collaborative, and we believe that capital is only one piece of the equation. Capital is part of the equation, but the coaching, the mentoring, the experience, the expertise surrounding young entrepreneurs, they may be young in age, they may be young in terms of experience, surrounding them with people who can help them get smarter faster and avoid mistakes. And so that's sort of the objective of the TenneSEED Fund, is to be an entity that will help produce quality deal flow for others who are looking at early stage investing at companies in this region.
A couple follow-on questions, and be thinking of some questions also, please, because we'll have a little time for Q&A with each panel. But first, two-part question. Are you typically the first check-in, Kristina? Do you prefer to be? Do you like to see friends and families already in, or there's another fund in, or you like to be first in or close to first? And then second, once you have written the check, what does immediate success look like? Is that a company that takes the check and is growing so fast it's burned in 6 months and they raise their next round? Is that they've gotten to a break-even point? Is it they've been acquired really fast within a year or two and returned money to the fund already? Or any of those will potentially work? What does success look like?
Well, we've had the latter happen, which was exciting. In about a year-long investment, we had a nice little return on that. But I think in general, what we're looking for is usually, okay, as far as stage we come in, usually there's been some kind of early founder money or friends and family has gotten to the stage where they could actually be potentially some revenue producing or have gotten that far along, so out of R&D and have a minimum viable product and all of that. So when our money comes in, it's usually co-investment. Our check sizes at 100 to 150 are not big enough to often lead around. Sometimes they are. We do find sometimes we are the first in if we're not, we might kind of co-lead with somebody else, because for women-led companies, it's all about access to capital, and they don't have the same access to capital that all the other companies do, which happen to be led by men. So, and most of the investor pool is men. So there's just a different dynamic going on there. So we do try to, if not the very first investor, we're working alongside another investor who's trying to leverage other capital. And one thing we do have going for us is that we are part of a national network of other women-led funds that are interested in investing women's capital, engaging women's capital and investing it. And so we sort of have created this fairly powerful now force of what we call gender lens investing across the country. And so we can syndicate deals out from here that we're seeing that we've put in that first $100,000 check, and we can round up the total 500 from other women-led funds. Or we can add value to a company by keeping it as a women-led company. So that is very important in retail, consumer goods, for slotting purposes. It's important in government contracting. So you can continue to have that women-owned equity position, at least at the early stage of the company, to be able to get some of that, the revenue leverage that you need. So when we're coming in, it's usually after that first super seed capital or really early capital that people have. But we like to we prefer to have equity rounds, and we prefer to have some kind of milestone out there. So often it's getting to, the $1 million ARR mark, a certain number of clients, certain number of users if it's a technology company, sales markers. We just did a recent deal where we came in and their first, so it's a 2-tranche deal, and the second tranche is going to be about getting 2 full states contracted for this company, and they are about to close almost fully on the first state. And so once they get that second state, that'll be and a certain number of users on their platform, that will trigger the second tranche of the investment that we're going to be in alongside some other investors. So we do tend to co-invest because our dollars, we're not writing a $250 and up check the first time around. We have led some deals because nobody else would, and written those term sheets, and so we are definitely available to do that and help coach through that, but it tends not to be the case with most of them. We did have one instance when early on was one of our companies that came out of Gig Tank that we led the investment, and then the second and only other investor in it was a very large VC firm on the West Coast who came in, and we had driven that deal, and we actually ended up driving the deal on the second investment level of that, so the second series round, because the founder wanted to preserve as much equity as she possibly could and didn't want to get completely gobbled up by the VC. So we were able to stay in that long. Now this round, we're not out, we're still in, but we're not leading it. But we were able to leverage some of our negotiating power in that. So we do try to add value where we can as a women-led firm when that entrepreneur is interested in that added value. So, yeah.
And Jack, do you guys operate similarly? Are you setting milestones out that maybe users, sales goals, et cetera? Do you have a timeline in mind when you put money in?
I think your initial phrasing of the question was probably accurate. Yet, D, all of the above. I think it's really important to set those expectations on the front end because, like you hinted at, sometimes the $50,000 is just to get to a milestone of like, this thing works. It plugs in and it fits. Sometimes the first $100,000 is to get to $1 million in revenue. I mean, some companies can actually do that. So I think setting those expectations on the front end are really, really important. And while they may not always end up in a term sheet with like actually, memorialized milestones that are going to be a structured deal where, more money kicks in when you hit them, I think to have those laid out with your board, even if it's an informal board at that stage, really, really important. And that feeds into the second step, as far as I'm concerned, of what happens after the investment. Look, Grady's totally right. We as fund managers are always thinking about fundraising. We have a million things to do. And it's not that we don't want to be engaged with our companies, but we're all human. And the squeaky wheel thing happens. And it's really easy to invest in a company and move on to the next deal or the next deal and only deal with the problems. Only put out fires but never really do the maintenance that needs to happen. So I would put it back on a lot of the entrepreneurs that if you actually find an investor that you think can add value to your company, you actually get to a term sheet, you actually get to a deal. And we got a couple of our companies here, the Rapid RMS guys have been awesome. When they need something from us, they reach out to us, we reach out to them. It's got to be a two-way street. And so making sure that the entrepreneur is leveraging the mentors that the investors want to put around you, that's really powerful. And that's, to me, one of the first indicators that this company is going to go somewhere and we're going to want to put more money in and do more introductions and really help. So, setting the milestones on the front end, really important for expectation setting, but then actively engaging where your investors can help you is really, really important for building that relationship.
And Grady, for you guys, is the horizon, is the time horizon a little different with an evergreen fund, or how are you guys thinking about structuring the deals?
Well, part of what drove our decision to form this fund as an evergreen fund is the opportunity to be more patient. Because even though the Southern Appalachian Fund is now in its 14th year, but in general, investors don't want to wait that long to get their money back. They really don't want to wait that long. And there's a lot of rationale for why it made sense to do it the way we've done it. But investors prefer not to wait 14 years to get their money back. And by structuring the fund as an evergreen fund, we do have the opportunity to be more patient and not have micro or macroeconomic factors outside of the fund and outside of the company really sort of dictate our time horizon. We are big milestone investors. I think setting milestones and trying to measure success based on accomplishment of milestones is critical. because it allows you to be objective. It allows everybody to be speaking about speaking the same language. It helps communicate between the investors and the management team. Hey, how are we going to define success? So we believe in that a lot. And and there's another point you made, Jack, that I wanted to talk about, but I can't remember what it is now. Whatever Jack said, that was such a good point.
What Jack said, it sounded great. So quick lightning round. If you had to choose one favorite exit so far.
We've only had one.
Okay,
So,
that's an easy choice.
yeah, part pick out of Atlanta. So they sold to Amazon. It was very early in the company's time horizon, but it was a good opportunity for her as a founder, and they've continued to incubate the company under the A9. So they're a virtualization company, and yeah, that was pretty exciting. It was quick in and out, but
So that
it was good.
within a year, you said?
In a year, yeah.
Yeah, I'd actually say, I may get the name wrong, David can correct me. It was a deal that we actually didn't do within the fund because of the geographic restrictions we had on our first fund, but the aerial biopharma deal that we did, we actually kind of syndicated it with a bunch of our LPs, which is something else we do a lot of. And that one's my favorite one so far because that one, the entrepreneurs actually recycled the capital. It wasn't their first rodeo. They upped for another one that led to another company that then exited later on. I mean, these guys have just been serial entrepreneurs. And frankly, that's one of the reasons I got into this was to see, to find those people that can just do it and they just get addicted to it and do it over and over and over. We're still in with those guys on their current company. But to see that happen, that's been my favorite one so far. Yeah.
TenneSEED hasn't made an investment yet, so you got to go back to the well.
No, but yeah,
for your
and
other funds.
I'll tell you one
All right.
because it's a company that was right here on Market Square. But I thought of my second point, and my second point is we're big on co-investing. My observation over the last 20 years is we don't really want to be in a deal all by ourselves. We don't want to be in a situation where it's our knowledge and our expertise and our decision making alone that is helping to drive the company forward, along with the management team. We want to invest with other smart people who also have experience, who have different perspectives, and the ability to write a check. And I think, as I look back over our companies that we've invested in, the most successful investments we've had, we were in a deal with other investors that we thought a lot of, whether they were angels or institutional investors. So there was a company here on Market Square called Eon Streams that we invested in. It was a local startup company, and at the time we exited that deal, that company was acquired by a company on the West Coast. Eon Streams was acquired by VitalStream, which then went public, and VitalStream was acquired by a company in Atlanta called Internap, and that was a 620% IRR for us. We invested $725,000 in a company that returned $64 million to shareholders within about 27 months. And it was an exceptionally good investment, and every single person in the company was homegrown right here in Knoxville. Steve Newman was the CEO of that company. He's gone on to do some other things with some other companies here in town. So the idea that there's a recycling of capital and there's a recycling of talent in the community is one of the things we like about that deal.
Absolutely. I just saw the stop sign. So if you do have questions, thankfully we're all here in a locked room. So if you have questions for Kristina, Jack, and Grady, grab them and ask. We had a couple hours to spend with each other today, thankfully. But thank you all for being up here on the panel. A round of applause for the panelists, please. And next, I'd like to introduce Chris Van Beek to come up and talk about his experience as an entrepreneur, raising around largely here in Knoxville and throughout the region.